$47 billion. That's how much money flows through America's tipping economy every year. But with good old cash, who knows if that's the real figure? Now, you walk into a coffee shop, order a $4 latte. The tablet spins towards you. 22%, 25%, 28%? You tap 22 and leave, wondering when coffee got this complicated. Yep, it got digital. Are you paying more than you would have with cash? Did the barista earn more money? What does this mean for the business owner with these new taxes and fees? What about the fintech companies? How deep in the tipping jar are their hands? From the customer point of view, it looks like an upgrade to something better. But instead, this accidentally restructured the economic relationships between 15 million workers, 749,000 establishments, and 340 million customers. And now, politicians are promising the no tax on tips bill will fix the system. Well, let's dive into the new complications of the digital tipping economy. The tradition of tipping in the United States has roots that most people would find deeply uncomfortable today. Following the Civil War, wealthy Americans adopted European tipping customs as status displays, showering service workers with small amounts while expecting excessive gratitude. The cruel reality was that wages for women and newly freed slaves were deliberately kept appallingly low, making tips not bonuses but survival necessities. This historical arrangement crystallized into today's federal minimum wage structure, $2.13 per hour for tipped workers, a rate frozen since 1996. While regular minimum wage workers have increased 171% since then, tipped workers still earn the same $85.20 for a 40-hour week before tips. Everything else, rent, food, healthcare, depends entirely on customer generosity. This system now processes approximately $47 billion in annual tips across America's service economy, with restaurant workers representing the largest segment. The dependence on customer payments has created what economists call the tipped minimum wage, but what might be more accurately described as legalized wage subsidization, where businesses have convinced society to directly fund their labor costs. The pandemic fundamentally altered our relationship with service workers and payment methods simultaneously. Cash transactions fell by 33% in 2020, while over 13 million Americans transitioned to exclusive digital payments, double the previous year's number. Contactless became not just convenient, but necessary for health safety. Between 2020 and 2022, many customers increased tips as a gesture of support for service workers who continued working in person. Harvard Business School researchers documented widespread over-tipping during this period, with customers leaving 25% and 30% gratuities as gestures of solidarity and gratitude. This pandemic generosity reset baseline expectations in ways that outlasted the health crisis. What started as emergency appreciation became the new normal, with digital payment systems perfectly positioned to capture and amplify these behavioral changes through preset tip suggestions and psychological nudges. The American tipping system isn't universal, and examining international alternatives reveals viable paths forward. Japan operates on the cultural principle of omotenashi, selfless hospitality where tipping can actually be considered offensive because excellent service is the expected standard, not exceptional performance deserving extra payment. In July 2025, Australia eliminated tipping dependence through a $24.95 minimum wage for restaurant workers, and restaurants still deliver great service. France integrated a mandatory 15% service charge into menu prices since 1985, ensuring workers receive minimum wage plus comprehensive benefits while maintaining transparent pricing for customers. These examples prove you can have great service, happy workers, and profitable businesses without relying heavily on tipping. What makes these countries work is simple. They pay workers decent wages instead of making them depend on customer mood and generosity. Yet, America's digital transformation is proceeding along a different trajectory, amplifying rather than replacing the existing tipping structure through technological sophistication that makes the system more efficient at extracting customer payments while creating new forms of complexity for all participants. Digital tipping systems deliver measurable financial benefits that shouldn't be dismissed. Forbes surveys show Americans tip nearly 15% more when paying digitally compared to cash, with some establishments reporting increases up to 25%. The psychological mechanisms driving this increase are well documented. MIT neuroscience research reveals that credit card payments activate brain reward centers regardless of price, while cash payments only trigger these responses for cheaper items. New York City taxi data provides concrete evidence of this effect. Average tips increased from 10% with cash payments to 22% with credit cards, a 120% jump that translated into thousands of additional annual income for drivers. The reduced pain of paying phenomenon, where digital transactions feel less tangible than physical cash, consistently generates higher gratuity amounts across service industries. For workers, digital systems offer crucial protections beyond increased earnings. Laura, a Starbucks barista, appreciates that digital distribution means less money for me to have to handle, while eliminating the safety risks of carrying cash during late-night shifts. Digital systems also prevent tip theft by managers, a problem affecting an estimated 14% of food service workers, through automated tracking and distribution systems. The convenience factor for customers also drives adoption. No more fumbling for cash, calculating percentages, or feeling awkward about exact change amounts. Digital interfaces handle the math instantly, presenting clear options that reduce transaction friction for both customers and businesses. However, these benefits come with significant trade-offs that affect all stakeholders differently. For workers, the most immediate impact involves payment timing. Ashley Torres, an IHOP server, explains, "I prefer cash tips, just because I get to keep count of how much I'm making." Digital tips often don't reach workers until their next paycheck, creating cash flow challenges for employees living paycheck to paycheck, which describes restaurant workers who are 2.5 times more likely to live in poverty than other occupations. Kim, a Starbucks shift supervisor, reveals additional complications. Digital tip distribution is dependent on proper time punches being logged, which isn't always the case by store managers. We don't see the amounts or how they are distributed. There's no more transparency there. Technology that promised transparency has actually reduced worker visibility into their own earnings, while creating dependencies on payroll system accuracy. The tax landscape for tips changed significantly in 2025 with the passage of the No Tax on Tips Act. This act eliminated federal income tax on gratuities for workers earning under $150,000 and $160,000 in 2025, though payroll taxes and state-local taxes still apply. This affects the digital versus cash calculation. Digital tips now provide clear documentation of tax-free income, which can be beneficial for loan applications and financial planning. However, about 37% of tipped workers already paid no federal income tax due to low earnings, so they see no change from this policy. Academic expert Helona Ox notes that having cash on hand is something that is beneficial for workers in vulnerable economic positions. Digitization removes this crucial financial buffer for low-wage earners, regardless of tax treatment, since workers still need immediate access to money for daily expenses. For businesses, digital tipping creates unexpected operational complexities. Hardware costs range from $49 card readers to $1,899 station systems, while platform fees average 2.6% plus 15 cents per transaction. More significantly, businesses become unwilling financial intermediaries processing money that doesn't belong to them, while managing tax compliance and payroll integration. Anna Lamb, owner of Nibble Cafe in Hull, Massachusetts, illustrates this burden. With the national insurance rise, if we collect $20,000 in tips over the year, I'll have to deduct $3,000 from the tips. Digital systems transform what used to be invisible economic activity, aka cash on the table, into documented business revenue requiring administrative overhead, tax calculations, and regulatory compliance. For customers, the convenience comes with psychological manipulation that many find troubling. Pew Research found that 72% of Americans believe tipping is expected in more places than 5 years ago, while 40% oppose automated tip suggestions. Now, screens are showing 20%, 25%, and 28% instead of traditional 15%, 18%, and 20%. Of course, this anchoring effect is made to nudge us customers toward higher amounts. The public-facing screens create social pressure that cash tip jars never could. standing in line, watched by the barista and other customers. Many people feel compelled to select preset amounts rather than risk appearing cheap by choosing custom lower amounts or no tip at all. This transformation of tipping from private gesture to public performance fundamentally alters the social dynamics of service interactions. The digital tipping transformation has created clear financial winners, starting with the fintech platforms facilitating these transactions. Toast processes $126 billion in gross platform, a 31% year-over-year revenue growth, serving 112,000 locations. In 2024, Square handled $241 billion in annual payments across its ecosystem, benefiting from the broader point-of-sale market growing at 16.1% annually. These companies extract revenue through transaction fees, typically 2.6% plus 15 cents per tip, multiplied across millions of daily transactions. Unlike traditional payment processing, tip transactions often involve higher percentage amounts, generating more fee income per dollar processed. The shift from cash tips to digital payments represents pure revenue expansion for these platforms. Certain categories of workers benefit substantially from digital systems. Establishments with high transaction volumes and affluent customer bases see the most dramatic improvements. Hotels using Tip Brightly's QR code systems report workers earning an additional 50 cents to $1 per hour. Restaurants with suggested tip features document increases up to 30% compared to cash-only periods. According to the White House, some workers may see up to a $1,675 annual boost. Business managers gain operational efficiency that translates into real cost savings. Digital systems eliminate 3 to 8 hours weekly of administrative work previously required for cash runs, manual calculations, and tip distribution. Katie Button of Katie Button Restaurants explains, "It's all about the fact that a software program is auto-calculating it based on their punches, rather than us in an Excel spreadsheet. Most establishments achieve positive ROI within 6 to 12 months through reduced labor costs and increased tip amounts." Digital systems also handle tax reporting automatically and track different state wage requirements, reducing paperwork and legal headaches for business owners. Small businesses face the heaviest burden from digital transformation costs. Beyond hardware investments, ranging from hundreds to thousands of dollars, businesses must integrate new software systems, train staff, and manage ongoing platform fees that didn't exist with cash operations. For establishments with thin profit margins, these costs can be prohibitive. More problematically, small businesses become unwilling financial service companies, processing and distributing money that belongs to their employees while bearing liability for system failures and compliance errors. When payment platforms experience technical issues, delays, incorrect distributions, or processing failures, businesses face employee disputes and potential legal liability despite having no control over the systems. Certain worker segments lose significant advantages from the cash to digital transition. Employees dependent on daily cash access for immediate expenses face hardship when tips are delayed through payroll systems. While the 2025 tax law changes eliminated federal income tax concerns for most workers, the loss of immediate cash access remains a significant disadvantage for workers living paycheck to paycheck. The loss of cash also eliminates worker autonomy over their earnings. Previously, servers could immediately pocket cash tips and make personal decisions about spending or saving. Digital systems create dependency on employer payroll accuracy, bank processing times, and payment platform reliability, removing worker control over money they've earned. Customers experience the most subtle but perhaps most widespread negative impacts. The psychological manipulation inherent in digital tipping interfaces creates what researchers call tip fatigue, with 70% of consumers reporting feeling pressured by checkout prompts. The anchoring effects of preset high percentages, often starting at 18 or 20% rather than traditional 10 or 15%, systematically extract more money through behavioral psychology rather than improved service quality. 66% of Americans hold negative views about tipping culture, with many feeling manipulated by systems designed to maximize tip extraction rather than fairly compensate workers based on service quality. Regulators occupy an increasingly difficult position as digital tipping creates new oversight requirements without clear policy frameworks. The complexity of multi-state operations, varying minimum wage laws, and platform liability creates regulatory challenges that existing frameworks weren't designed to address. The numbers tell the story of an incomplete transition. While 84% of restaurant transactions are now cashless, 90% of establishments still accept cash tips. This hybrid system creates double complexity. Businesses must manage both digital and cash processes, while customers navigate inconsistent expectations across different venues. The No Tax on Tips Act expires in 2028, creating uncertainty about long-term tax treatment and adding another layer of complexity for businesses planning their tip distribution systems. Technological solutions addressing digital tipping's friction points are rapidly emerging. Kickfin's automated distribution platform eliminates payroll integration complexity by handling tip calculations and payments independently. This reduces administrative burden while maintaining worker access to daily earnings. The Federal Reserve's FedNow instant payment service promises to eliminate the delays that currently separate workers from their digital tips. Policy innovations are also gaining traction. The UK's new Employment Act requires 100% of tips reach workers rather than being retained by businesses, while Washington, D.C.'s Initiative 82 phases out tip credits over 5 years, gradually eliminating the two-tier wage system. These policy changes tackle the root problems instead of just making the technology smoother. Service charge models represent another promising direction. Instead of voluntary tips subject to psychological manipulation, restaurants implementing 15 to 22% automatic service charges can pay stable wages while maintaining transparent pricing. San Francisco's Encore restaurant uses a 20% service charge to pay kitchen staff $28 per hour, showing that workers can earn stable wages while customers know exactly what they're paying up front. Danny Meyer, an entrepreneur behind some of New York's most successful restaurants, including Shake Shack, attempted to eliminate tipping at his restaurant around 2015 and 2016. It failed, but the lessons learned inform current experiments. Meyer's approach to raising menu prices 20 to 25% while paying guaranteed wages encountered resistance from both customers who disliked higher prices and servers who earned more through unpredictable tips than guaranteed wages. However, more recent implementations show greater success through careful design. Restaurants implementing service charges rather than menu price increases find less customer resistance, while profit-sharing arrangements address server concerns about income reduction. The key insight is that eliminating tipping requires comprehensive system redesign, not just pricing adjustments. Tipless restaurant models report mixed but increasingly positive results. While some establishments face customer resistance or server departures, others thrive by attracting workers seeking stable income and customers appreciating transparent pricing. Whether these experiments succeed or fail seems to depend mostly on how they're implemented and what the local market expects. In my opinion, 3 scenarios could unfold over the next 5 years. The most probable involves continued hybridization, coexistence of cash and digital tipping with improved technology addressing current friction points. Instant payment systems, reduced fees, and better worker control interfaces could preserve the benefits of both systems while minimizing their respective disadvantages. Alternatively, service charges could become mainstream as customer resistance to manipulative tip prompts grows stronger. If enough establishments adopt transparent service charge models, competitive pressure might force industry-wide adoption, finally eliminating the uncertainty and psychological manipulation inherent in voluntary tipping. The least likely but most transformative scenario involves federal regulation standardizing service worker compensation, potentially eliminating tip dependence altogether through minimum wage reform. While politically challenging, growing awareness of the system's inequities and international examples of successful alternatives could eventually drive comprehensive policy change. Speaking of policy changes, have you heard about the dismantling of the credit card reward system? If you use a credit card, you probably should take a look at this video.